Started with $1 in a dream. This one for all the people that said I couldn't do it. You know the
Good
best
day,
feeling in
Forex
the world.
chasers. Thank you so much for making it up to lesson 13. And on this lesson, we'll be looking at the falling wedge and the rising wedge. The topics that we're going to cover are: what are wedges, the difference between falling wedge and rising wedge, how to identify wedges, how to enter trade, stop loss and target profit, high probability setups on falling and rising wedges. Okay, now we're looking at the first topic. What are wedges? There are multiple price wave patterns. Wedges form when the waves of an asset move within a narrow range, angled either up or down. When the pattern completes and the price breaks out of the wedge, it is usually in the opposite direction the wedge was pointed. This is why it can act as both continuous or reversal. That's very nice. Let's look at what they mean when they say so. It's a narrowing range angled either up or down. Okay. The difference between falling and rising wedge. Okay, in this case of a wedge angled upwards, rising wedge, the breakout is typical to the downside, indicating the lower prices to come. Okay, I believe we saw that now. We're looking at the rising wedge. It means that the rising wedge, the narrowing angle is pointed to the upside, to the upwards direction, meaning that it indicates that the next possible movement that are going to come are downwards, whether it's in an uptrend or downtrend. Because you can see on the left side here, down here we wrote on uptrend it acts as reversal, meaning that on an uptrend it'll like a rising wedge basically means that it's going to break to the downside, meaning that if it's an uptrend it's going to act as a reversal and go down, but then if it's a downtrend it's going to act as a continuation and still go down. Okay, can you see that? On an uptrend it acts as a reversal, on a downtrend it acts as support, as continuation pattern. This is a rising wedge. You can see price pushed upwards, came back down. This is a higher high, higher low, higher high, higher low, higher high, higher low, higher high. And then it failed to create a higher low here. It broke to the downside. But when you look at when you draw the pattern, you can see that it's becoming narrow. Like um, it's ascending in a manner whereby you can see that the bulls. Okay, what I can say from this correction here is that you can see that the bulls are running out of momentum. The bulls are because if let's say the bulls were strong, they were supposed to push up, just to push up without having to go in a narrow pattern like this. Even here you can see that it came back down, it came down from upward, came back downtrend, then it started giving us this rising weight in a narrow form, which means that it's going to break to the downside. It shows that the bulls are not so strong. They are not so strong. Okay, now let's take a look at the falling wedge. In the case of a wedge angled downwards, falling wedge, the breakout is typically to the upside, indicating higher prices to come. Meaning that you can see, as long as it's a falling wedge, it means that it's going to break to the upside, whether it's in a downtrend or uptrend. Same thing with the rising wedge. Okay. On uptrend, it acts as continuation. You can see that price pushed upwards, then started giving the lower low, lower high, lower low, lower high, lower low in a narrow form. It shows that the sellers are, they don't have momentum, they don't have so much momentum. You can see that they're running out because they're becoming smaller and smaller and smaller and smaller. Then eventually they'll break to the upside and continue the upward movements. Same thing happens here. You can see that it came from the upside, came all the way down, and started giving us this pattern, started correcting in a narrowish downtrend. You can see because it's lower low, lower high, lower low, lower high, lower low. So it's becoming narrow. It shows that the sellers are running out of momentum. So the breaker was to the upside. This basically means that the buyers are gaining momentum. The sellers are running out of momentum and the buyers are gaining momentum. Okay. Now let's take a look at how to identify wedges. We've got the rising and the falling wedge. We both know. Okay. With the rising wedge, you can see that price came. Okay, it doesn't have to mean that it's an uptrend, because it can, rising wedge can still form in a downtrend, meaning the same thing. It creates higher highs, higher lows, higher high, higher low. There we know it creates that in a continue, like the correction creates higher highs, higher low, higher high, higher low. Because you get this in a correction phase, not in an impulsive phase, in a correction phase. So when you see that it's correcting high highs and high lows, but then the pattern, if you add them up, if you converge these lines together, you're gonna see that they're going to be forming a narrowish angle, meaning that you can see that okay, let me see what's written. You can see, but then you can see here the support line here is becoming a bit, it's pointing to the upside, né? It's becoming a bit steep to the upside, but then this resistance line, it's almost like it's approaching the support line. Okay, formed when the formed when price consolidates between upward sloping support and resistance lines. Okay, the slope of the support line is steeper than that of resistance. You can see this one here, it's steeper, like they're both pointing to the upside, but then the support is steeper compared to the resistance line. That's the best way to understand it. A rising wedge simply leads to a downtrend, which means that it's a bearish chart pattern. It's a bearish chart pattern, whether you find it in an uptrend or a downtrend, it simply leads to the downtrend, to the downside. Okay, let's look at the falling wedge. Can see that in a corrective phase, price was forming lower lows, lower high, lower high, né? But then you can see that it's forming it in a narrowish angle. It's not forming it in a flag pattern, it's forming it in a narrowish angle. So you can see that formed when price consolidates between downtrend sloping support and the resistance line. Okay, the slope of the resistance line is steeper than that of the support, meaning that this resistance in the falling wedge, the slope of the resistance line is steeper compared to the support line. Okay, I believe we can see that the slope of the resistance line is steeper compared to the support line, even though they're both pointing to the downside. And even here with the rising wedge, they're both pointing to the upside, but then the support is much more steeper than the resistance. Okay. Okay, now let's take a look at placing stop losses and take target profits. Okay. Now with the falling wedge, you started here with the falling wedge. With the falling wedge, né? Whether it's downtrend or uptrend, the principle applies on the falling wedge itself. After price has broken the structure, after price closed above your trend line here, you enter here, you put your buy stop above the previous candle that closed above this trend line here. Where you put your stop loss below the lows, like the previous lows, that's where you put your stop loss, né? But you don't exactly put it there, you put it at least like a few pips below. This is personal, it depends on how many pips you prefer to put it, but then I'll say something like, let's say 4 to 8 pips, né? Below the previous lows, because it means that let's say if it happens that price went up and then came back down to want to retest this trend line and still continue to go all the way up, you see that if you place your stop loss somewhere around here, okay, let me draw this here so you understand what I'm talking about. Okay, if let's say price broke out, you enter here, né? And then let's say you put your stop loss here, you want to be safe, it's like, I don't want to lose 30 pips, I want to lose 15 pips, and then you put your stop loss here. Price come back to retest the line as support, it takes you out. Can you see it hits your stop loss and then it continues to go upside? Can you see that? Or let's say if you placed it exactly at the low, price might come back, let's say fail to break this high, come back at the low, hit your stop loss and then go up, creating a double bottom. Can you see this? So you have to give it the room to breathe. Just give it like 8 pips. I think that's enough, 5 to 8 pips. Same thing with the rising wedge, because this was the falling wedge. Rising wedge, as soon as you entered somewhere here, price broke, you entered somewhere here, put your stop loss a few pips above the previous high. Can you see it? Just a few pips, because we know that if it does, let's say if it does break this one here, then it shows that it was invalid. Your pattern was invalid. That means that we evolve. Then we can have a pattern like this now, which shows that the rising wedge is invalid. Can you see that? So we have reasons of why we say our price is valid or invalid. Okay, now let's take a look at the target. The first target would be at the starting point of the correction, judging by the higher time frame. The second target would be the length of the impulse phase. Okay, impulsive phase. Meaning that the first target, let's say when your rising wedge came back down, it broke out here, you entered here, your stop loss would be here. Your first target would be at the starting point of the peak, right here, the starting point of the correction. This is your first target. So once price gets here, what you can do is that you can manage your trades, see how it reacts at that point, and let it run to go try to reach your second target, meaning that your second target is the length of the impulsive phase. This one here, let me draw it. This one here, this is your target here. Okay, let me do this quick. Okay, yeah, this one to this one. So if it's 150 pips, if this length is 150 pips, then possibly you're going up 150 pips. Can you see that? But the first target is at the high, the first high. Then the second target, you let it run. And you can use higher time frame to see your, let's say in this manner, you're going up. You can use your higher time frames and then you see your resistance line, like your resistance where it can possibly come back. Okay, even here, the same thing, the same principle applies. Your first target is at the, yeah, at this point here. Can you see it? And your second target would be the length of the sun here. Can you see that? This is like the reason we're putting our target J is that it has to do something that we call the 90% rule, meaning that the 90% of the time price has to come back at the starting point of the correction phase where it has started to correct. That's 90% of the time. It works in all patterns, your flags, your triangles, every pattern. Okay, I believe we saw that. Okay, chasers. Now let's look at high probability setups that we can take advantage of trading the rising wedge or the falling wedge. Okay, in this manner, let's take a look at the rising wedge. Let's say price pushed upwards like this, that it's doing something like this. Okay, you can see here we've got the support line. You need to have 2 points. 2 points, like the first point, the second point. You have here the first point and the second point. So you have something like this. Okay. So you're able to see that price is forming a rising wedge. So one of the high probability setups is if you wait for it to reveal something like, let's say it goes up to this point here. Okay, can you see this point here forming sort of like a double top? This is the first high probability setups that you can take advantage of. Advantage of these high probability setups is that the reward is much more greater than taking the reduced risk entry. The reward is much more greater, but disadvantage is that you are more likely to hit stop losses because you're entering before structure is really like it has confirmed that we're going down. Okay, but the reward is very good. Like it's possible to get like a risk reward ratio of 1:8, 1:10, utilizing these ones. Okay, so you can see the price scheme here. It's forming a double top, and even though if let's say it happens to come and touch this resistance line for the fourth time, let's say you put your stop loss like what 20 pips above here, it happens that price comes back up, entering seeing the double top, or let's say price happens to come and touch this point, it won't take you out because your stops are much more protected. Then when you go down, you're already in profit when people are entering at the breakout. Can you see that? And then you proceed with it. Okay, now let's take a look at another different method, like to take a risk entry. I mean a reduced risk entry. Let's say it came back, it broke out now. It broke out. I'm showing high probability setups only, not the normal. Isn't the normal one? It's this that you just enter somewhere here. But the the reduced risk entry is it has confirmed now that it broken out, price is reversing, it's going down and everything. It has confirmed all of that. So you wait for a move like a continuation pattern, a small one, tiny one that confirms that we're going to the downside, and then you take this continuation pattern. Can you see it? Then your stops are here. Your targets is, let's say you can use your first target here, then your second target all the way down there. Can you see this? So you wait for the break to confirm that we have already broken out, and then you wait for a continuation pattern to take advantage of. A continuation pattern to take advantage of. Okay. Okay, this is the second. Let's take a look at the. Okay, let's say price happens to come then here and something like this, then here. Okay, then you can see if you take these, you have that, take this, you have that. Can you see that it's forming a rising wedge? This is how you see your rising wedge, because it doesn't, you only need 2 points, 2 points at the support, 2 points at the resistance. Then let's say it happens to come back and say the third touch, but now it goes up with the third touch and it does something like an ascending pattern. Okay, ascending pattern. When it gets here, you have a pattern in a pattern, something like this. Can you see this? This is one of the most greatest high probability setups because you're taking a pattern in a pattern, meaning that when the sun here breaks, you enter here, your stops are just here. Can you see it? And your first target, remember your first target is here, and your second target is somewhere around here. Okay? So advantages, you enter here, and let's say it does something like breakout here, then maybe a mini, and then you take this one here too. You enter here too. Okay? When you enter, you move your stop loss from here, you move it to here, you're already in profit, you even break even, and you take another entry here. Then you capitalize on it. You might find out that this one gives you 250 pips, this one gives you like 190 pips. So overall, you locked like 450 pips on one trade. Can you see that? That's the advantage of it. So it even applies in the, let's say, let me see something like this. Okay. You'd have something like this. Then you'd have something like this. Then it pushes up. Then you can wait for a move like this. When it touches it, you'd have something like from here to here. And then once it breaks out, let's say this one here still goes down. Once it breaks out, you take this one here, put your stops here. Then it broke out, then it goes all the way up. Then you might possibly take this one here too. Can you see that? That's the advantage of it. The advantage of entering these high probability setups. Okay, now let's take a look at them at the lifetime market. Okay, Jesus. Now let's take a look at the euro dollar on the 1 hour time frame. We're able to spot a nice rising wedge here. Can see okay, let me draw this here. Okay, can see price pushed from here to the upside, me. Then came back down. Can see this is our first touch. Here's our second. Here's our first. Here's our second. Me. Then can see here the third touch. It done what? It broke out. So mean that this breakout candle, you place your buy stop above it. That's why it's very important to put your buy stop. Can you see it? Okay. Then done this. It done something like this. Then it activated you and then went straight into profits. Can you see this? The first target, we say that it's something like this. It hit it here. Can you see it? Your stop loss is placed right here below. First target is here, but then the risk reward isn't that good. So I wouldn't take the setup. Instead, I take this one here. This usual time frame one. Meaning that when price hits the first one, I put my stop loss at break even. Yeah. Put my stop loss here. And now it moves up and up and goes all the way. Let me see how many pips this is. Let me see how many pips. Okay, from here to here. Okay, 227. And already it's in what? Already it's in 90. Okay, it's in 84 pips. So you can keep on doing what? Adjusting your stops up until it gets to that specific point that we're speaking about. Okay. And there's a lot of rising wedge and falling wedges that you get. There's a lot of them that you get. Here's another one. See this one here. Okay, let me remove those drawings here. Here's another falling wedge here. Market price came from the upside. And this, okay, sorry, let me just explain. This is the falling wedge, ne? This is the falling wedge. You can see the wedge is in a narrow to the downside, ne? It's a falling wedge, and this is the rising wedge. Okay, can you see that? So you know the falling wedge, it breaks out to the upside, and this one, in this manner, it's acting as a continuation because it's coming from the upside. It corrects, and then it broke to the upside. In this manner, yet it's a rising wedge, and it's acting as a correction, acting as a continuation too, because it's coming from the upside, going all the way down, and then correct. Okay, came all the way down and then corrected, impulsed all the way down. Can you see this? Okay, like let me just draw this quick so you're able to see. We experience something like a move like this, then a move like this. Then can you see this here? Okay, believe you guys can see that. So in this manner here, a rising wedge. A rising wedge that we've got here. We sell it here at the breakout here. It's very important to put your sell stops below, because this is the breakout candle. If you sell immediately, see what was going to happen with you. But when you put your sell stop below, see it activated you, it went down same time. Your first target is here, and your second target is let me see here. Yeah, 200 pips. Okay, at the NT 200 pips. Okay, let me just move this a bit lower, so we're able to see if it hit our second target or what. Here would be your entry, 200 pips, eh? Your entry here, 200 pips. Okay, yeah, it even went 280 pips. Can you see it? So yeah, that's how you tackle these patterns. And as soon as, like, when it drops down, and then it broke this. Can you see it? This was your support level. It broke it, and then it came and treated it as resistance. So what you do is that you move your stop loss from here, you move it from here, and then you move it to here. Can you see this? You move your stop loss to here, and you can see this is one of the high probability setups that it showed. This area here, it acted as sort of what? As sort of a double top. Can you see this formation here? A double top. And then it went all the way down. So I'll stop just below here. Then you take it and go all the way down. Here's another pattern here. This was one of the high probability setups that we took. Can you see I took this pattern before? Like, yeah, I saw this pattern here. There was this pattern that happened. Okay, like this, and like something like this here. So instead of me waiting for it to break here and then entering it after it broke out, I saw another pattern in that pattern here. Can you see it? So what pattern was that? It's a rising wedge. A rising wedge, because you can see the support is much more steeper compared to the resistance. Then it broke out here. Broke out. I took it as soon as, because I always take with sell stops. Like, as soon as it closes below the line, that's when I start doing what? Placing sell stops below the candle that closed. So I put the candle here. I mean, the sell stop here, it went down, and then I captured what? The risk reward 1:2. I had two positions, and that the one kept on moving the stop loss to the other one. And I thrill stopping it, because that's what you do. You let your first target be hit, and then you thrill stop all the way. Okay, I believe we saw the rising wedge and the falling wedge, guys, and there's a lot of them that you'd get. There's a lot of them that you'd get, like even in this manner here. Check this out. There's a lot of them. Okay, there we go. Then we'd have something like, let me take it from here. There we go. Can you see? Okay, it acts as something like a flag here, but you guys can see it breaks out here. You put your stop loss here, then your targets here. I mean, you can even have something, because you can modify it a bit. Just that I don't like forcing patterns to appear. Can have something like this. Okay, let me just put it a bit low. Something like this, and then that's when you can even add that pattern that we were seeing here, like this. Okay, yeah, just like this. Can add that pattern like this for a second confirmation. Can you see it? And then okay, in the bigger structure, you've got this rising wedge, but then you can take a sell as soon as it closes below here. At the same time, you're waiting for this one here to confirm too. You see, and it's a good trade as long as you're not risking more. Like your risk reward is great. It's more than 1:3. Let's say you took it at the breakout of this one here. Okay, 30 pips. Target is here, because your first target we said it's something like here, ne? And your second target is here at the low. Can you see risk reward is 1:3? It's also a good trade that you take. Just that I don't just take these patterns when I see them. Like, we get a clear direction on what's happening, where's the market going. If the downtrend, let's say the downward move is much more stronger than the upward move, like we'll show you this in the later chapters on how you can capitalize on combining these strategies. Okay. Thank you so much for paying attention at this lesson, and we're looking forward to having you at our next lesson. Thank you.